Welcome to Insights. I'm Eric. We're going to talk about the bond market, the stock market, all sorts of markets, probably precious metals, a little bit of equities, a little bit of different sectors within there, even the currency market and the dollar index. They're all tied in. Let's focus here on the bond market. The 10 years flipped. The TLT, which is the long bond, flipped a month ago, so it's on count of three. Just want to point out that the price cycles across the board, we'll start on the primary, are extended. They're red. It's not statistically significant, but trust me, these are not volatile markets. So these are really big readings. It's red here in the primary. It's red in the weekly. We have 2.4 and 1.8. And in the daily, you have 2.9 and 2 and a time cycle of 2 and almost 1. And there's various, these are the corporate bonds and junk bonds, these are high grades. The downturn in the bond market is pretty substantial and it's lasted. It's really sharp and fast, and it also has to coincide with an interesting energy build setup, which we'll have to get to. It's also within a backdrop where the NASDAQ 100 has fallen out of alignment. We're still in the primary trend is up and everyone's patting themselves on the back for being long stocks, but we are entering consolidation. We're 9 days into it. There's quite a substantial slide because this slide is actually generated above normal return for the daily down impulse, which is NASDAQ's more volatile than other sectors, so that's pretty sizable, probably getting close to double digits already. The weekly trend is, it's a bit extended still. Everything's still up, so this correction could continue. Let's take a look at the individual charts here. TLT has made a power slide. That's the 20-year plus. The 10 years following similar pattern. Now we've appearing to be retesting those lows on lighter volume, so this could be bottoming action, at least over the short term, and it could coincide with the dollar rally, which we also saw. And that probably warrants an individual review all by itself. A jump above the swing high that it's focusing and organizing a counter trend rally, which may or may not flip the primary trend. The NASDAQ 100 has also had a hard slide, and it's taken out whether it's this neckline or we generate another one here and pull it over straight forward like that. This is broken through, and it's broken through with pretty sizable force. So we curl back up here and we fail. That's going to place this, and the computer's going to pick up on that, and we're going to talk about that in reversal zones, and there probably is some reversal zones embedded around here. This could roll over again as possibly the bond market and currency market rallies. These are possibilities. The Treasury bond or the composite bond DI is quite interesting too, as all this is setting up and everyone's given up on the bond market. Clearly the invisible hand has not. DI and DI2 are really, really high. Only a few other times did we reach higher levels on DI2. I marked them with these arrows here. And they marked really sizable returns where they turn the market and turn the market here. It turned the market here and ultimately set up this powerful rally. DI2 can still go a little bit higher, needs to get up to the white line, but we're only a couple more weeks away from that. It's possible that after this week trading action, we saw a sizable DI spike again, but it could even be 100, and that would pull this up even faster. The equity DI, it's rising, but what I'm trying to suggest by these arrows is after lows are reached, whether it be below this threshold or these thresholds, there's a rally stage. This is a bearish oscillation. If you line up some of these red arrows and start them, and ultimately there are consolidation periods that can end in a significant sell-off of some sort. Not always. Sometimes the bearish oscillation starts here and then it goes into a trading range. And then you have another one form here, and this one slid down. But ultimately these bear setups can see the market go sideways, slow down, or a significant, this was a recessionary and a deep sell-off too. But this is a bearish oscillation. It's moving slowly higher, and it can go get to here, but the point is it takes time. We're within the midst of a multiple month bearish oscillation, and it's not going to go away. So if everyone's thinking that this is probably safe here, or the Nasdaq, then this is the Nasdaq, or the S&P 500, or the Dow Industrials, I mean, this is all taking place as energy is oscillating from a low to a high point, and let's not forget that. Precious metals within all this was pinned to the ground, but it's finally releasing itself as the frustration phase is kicking in a downside move. We still have a long way to go. I talked about in the gold review, this has to go way up into this range. It could be a quick sliver, but this is probably still a month, several months away. So patience needs to be adhered to. But this is also probably tied to all that's taking place here. Sell-off in the stock market might coincide with a sell-off in the precious metals or continuation, and this might be related to the rally in the bond market and the rally in the dollar index. We don't know, but these are possibilities, and it is, even though there was a sharp rally on Friday, I don't know if I would feel exactly comfortable with it yet, and we're going to see more of that here as we pull down. Here's TLTs, and this is the weekly reversals. You can find those here in this tab. Go through. We're just going to focus on the weekly, and I'm going to focus because it doesn't change as much and it has the most detail in terms of where the support lies. Dailies can flip through them fast. Monthly doesn't have as much. But we are getting into this congestion zone, this heavy block, green, red. This is a logical area for support. Now, with such a large bullish energy build here in a support area that both TLT and IEF, or the 10-year, are falling into, this is a logical place for the rally. And as I've said in publishing the matrix this morning, either the invisible hand has fallen off of its rock, or it knows something else that's coming that we're not talking about. Perhaps the Feds is going to be forced to control the yield curve or start an enormous QE program in order to keep interest rates from rising. Rising interest rates, long-term, 10-year, are going to have a major effect on pension funds, which are loaded up on debt. They can't just let it go and let the market reset. You're going to have bankruptcies, and you're going to have insolvencies left and right. I don't know how they're going to pull it off, but ultimately the Fed's going to try and act like a market maker for everything, which ultimately is going to sow the seeds of its own demise and another crisis, which is only a matter of time, really. Here's the NASDAQ 100's reversals, and we can see that there's a red line up here which has formed and is probably going to cap the rally. And I know people are thinking, oh, we're ready to take off, but ultimately that reversal zone marked by a large upward, the upper side of the channel, we could be heading down in the corrective or the bearish oscillation that we're seeing, which is the upward movement. Equities could be moving lower, and it could test this band here. Really bad one would test this breakout point. It's all of them are possible. I know that no one thinks anything bad can ever happen, but it's hardly that in the real world. The unexpected often materializes, and you have to have contingency plans, and you have to understand what the risks are. And those risks, I'm going to touch on them right here below, which I've talked about in dividend yield cycle reviews. Go watch those in detail. I know the production quality of the videos are not quite as good, but I'm going to pull some of the charts from them and show them updated here. This is the 1 through 4 cycle. This goes back a long time. I mean, the dividend yields, which is the 1 through 4 mean for the 1 through 4 dividend yields, so it's the mean score for all of them, goes back into the early 1800s. As far back as I can find dividend payouts for railroad companies. There wasn't many stocks listed on the exchange back then, but they predominantly were the leaders and the dominant shares at the time. But it defines cycles within shorter term. 1 and 2 are shorter long-term cycles. Then there's 3 and 4, which are more of like the intermediate and long-term cycles. And it combines all of them together. Above here are bullish points, below here are bearish points. And I had the computer highlight the bearish points, and you can see that 20, 2020 and 21 have similarities between 1998 as we run up to a top, 1986 and 87 before the market crashes, 1955 mostly because we broke above the depressionary high and the market was extended. Now that caused a temporary sell-off, but it didn't stop the market. But the whole point is when you get readings like this, the market almost inevitably pauses over the intermediate term at least. You can also see that the 1929 high here developed and we crashed, and some of the low marks that didn't quite get highlighted but also either formed a rolling period, a sell-off right away in a rolling period, or actually short corrections within. This was considered to be the long depression in the United States before the depression showed up. But they're all there, and what you're seeing is a minus 2.25 reading. That's one of the lowest on record. That's below even the 1929 point. This market carries enormous risks with it. The price has accelerated way above the it's not quite to say the fundamentals, but the speed of which companies pay out of their earnings. They pay out through dividends. Dividends are either going to have to spike very quickly, or the price of equities is going to have to slow down to match the payout pace that's taking place. We'll see what they do. I mean, there's no other way to say it. The computer is just going to watch what the companies do. It's going to observe. It's going to incorporate them into the cycles. But right now, we're pinned to the floor. We're either setting up with a nasty 1987 style correction, which then the market spikes that way as it collapses, or we go into a flat-out depression that might be bigger than the 1929 depression. The long-term cycles, even longer, which is 1 through 6, it includes 5 and 6, creates a mean score of minus 1.84. That's not as low as the 98 experience that set up the high from 2000 and the sharp sell-off. It's not quite as low as the 1929. There's not many of these readings, but we're really close. You're only a handful of ticks downside before we create a similar setup of these two time dates. So if the market would rally for another 12 months or so, and we get this outcome, you're most likely going to get a devastating economic crisis out of this to some degree. Not to some degree, it probably will supersede both of these. I would assume it will be with the currency will collapse and they'll try and cancel various things, and perhaps that's all part of the plan, but something is going to take place, and the risks are enormously high. Now, the public is completely unaware of this stuff, and I think that that's what they count on. They have to find someone to sell into, and you need liquidity to do that. No better way to get that done than to beat the drum of bullishness and have everybody monkey pile into the trade while the world's smartest money exits out of it. So keep an eye on these. This one is not in the matrix, but this is in the matrix down in the lower cycles trends tab. I'll show you here. They're right here. This is highlighting a very high. This is the highest number ever at this time and date, and so we have some real problems. Of course, this all could translate into a comfortable transitional rotation where the small caps and everything else does well because the economy is recovering. But if we look at the EAC, and you can go click the latest review, this economy is nowhere near as strong as they advertise it. It's just barely sticking its head above the water. You can go study on the blog or go look it up. There's an EAC review. The latest one discusses it more in detail. So that's the setup. So, I mean, the only thing I will add at this point, see the bond market and the invisible hand is fallen off of its rocker. It's crazy. It's lost its perspective, or it knows something else that's coming and that we're not talking about. Now, we're talking about it here, and unfortunately, that's probably just talk, and most people won't be ready for what happens because it's really hard to do something against primary trends. I mean, you're going to short the NASDAQ 100 against a primary trend. You're going to have to wait for the primary trend to turn down, and that takes time. But you also have to be prepared for something unexpected happens. Sometimes getting a short position is not the play, but sometimes standing to the sidelines is the smart play. And we can watch how this happens, but if the dollar continues to rally and the bond market continues to curl back up and starts to move and the Fed starts announcing very unexpected things, or who knows, a stumbling in the stimulus package. These can all affect the outcome that we are starting to see here being described through these charts and through the interrelationships and intermarket trends, which the invisible hand is talking to us. It's just not coming apart within the headlines yet, or it being discussed or broken apart. That comes usually after the fact, after the pain is being decimated or disseminated, not decimated, disseminated downward to us. And then we talk about it then afterwards. So we're listening to the invisible hand now. We're going to follow it up. I'm going to do some more specific reviews on individual markets that we talked about. This is kind of an overview. I'm going to lump it in with the, I don't know, stock or bond market or something. It's something that's an important. If you have any questions about what we're talking about or the risks involved, write some comments below or contact me directly. You know how to do that. If you know anyone else who is completely unaware of this stuff, I would have a conversation with them. I would direct them towards this video. It's a subscriber video, and I encourage them to subscribe. This is information that I'm not seeing out there much being talked about because nobody really wants to have that conversation. It takes a bold understanding of what the invisible hand is saying, and most people just lack the skills and don't have a computer that can talk about it. So introduce them to these concepts now. They may have 10 or 12 months, and then the world's going to probably dramatically change on them. If you need any other help, let me know. If not, thanks for watching the video, and keep your optimism, and life's going to go on regardless of what happens. But enjoy your weekend.